Japan was supposed to dominate the 21st century. Its economy was unstoppable. Its technology led the world. Its future looked inevitable. And then it stopped growing. Not for years, for decades. So what broke Japan's economy? And why could the same thing happen again? In the 1980s, many believed the 21st century would belong to Tokyo. Its technology was everywhere. Its companies dominated global markets. Its products defined innovation. Its exports flooded the world. And its economy was growing so fast that some believed Japan would eventually overtake the United States as the largest economy on Earth. This was not fantasy. At the time, it looked inevitable. Japan had become one of the greatest economic success stories in modern history. From the ruins of World War II, it had rebuilt itself into a global industrial superpower. Its factories produced world-class electronics, cars, and machinery. Its workforce was disciplined. Its institutions were respected. Its growth seemed unstoppable. To much of the world, Japan looked like the future. But then something happened. The machine stopped, not for a year, not for a recession, for decades. Growth collapsed. Asset prices crashed. Confidence disappeared. And one of the most powerful economic miracles in modern history entered what would later be called the lost decades. So what happened? How did one of history's strongest economies quietly break itself? The answer begins with confidence. Too much confidence. And history has a pattern. When economies become successful enough, they often begin to believe they are different, that the rules no longer apply, that growth is permanent, that this time is special. Japan fell into that trap. By the late 1980s, money was flowing everywhere. Interest rates had been kept low. Banks were lending aggressively, investors were borrowing heavily, and asset prices exploded. Stocks surged to impossible levels. Real estate prices climbed into absurd territory. At one point, the land underneath Tokyo's Imperial Palace was said to be worth more than all the real estate in California. That sounds ridiculous. Because it was. It wasn't real value. It was speculation. And speculation always feels rational while prices are rising. That is what makes bubbles so dangerous. They do not look insane when you are inside them. They feel obvious, natural, permanent. People stop asking whether prices make sense. They only ask how much higher they will go. And when an entire system starts believing that, collapse becomes inevitable. Japan's government saw the danger. Its central bank feared the bubble was overheating, so it acted. Interest rates were raised sharply. Credit tightened, and suddenly the momentum reversed. That was the moment everything changed. The stock market collapsed. Real estate prices fell, and trillions in paper wealth disappeared, almost overnight. For investors, it was devastating. For banks, it was catastrophic, because many of the loans they had issued were backed by assets that were no longer worth what they appeared to be. And when asset-backed debt collapses, financial systems weaken fast. Banks became trapped. Many were technically broken. But instead of forcing rapid restructuring, Japan delayed. Bad loans remained hidden. Weak institutions were protected. Losses were postponed rather than confronted. This decision seemed safe at first, but it created something worse. A zombie economy. This is one of the most important concepts in financial history. A zombie economy is what happens when failing institutions are kept alive artificially. They continue operating, they continue existing, but they stop functioning efficiently. They do not innovate. They do not take productive risks. They survive, but they do not create growth. And over time, this quietly drains an entire economy. That is exactly what happened in Japan. The banking system became cautious. Businesses stopped investing aggressively. Consumers became fearful. Confidence evaporated, and economic energy slowed. Then came deflation. This made everything worse. Deflation sounds harmless. Lower prices sound good. But in economic systems, falling prices can become dangerous, because when people expect prices to keep falling, they delay spending. Why buy today if it will be cheaper tomorrow? Businesses respond by cutting investment. Hiring slows, wages stagnate, growth weakens further, and the cycle reinforces itself. This is what trapped Japan. Prices drifted downward, demand weakened, and the economy entered paralysis. The government tried to fix it. Interest rates were slashed to near zero. Massive stimulus programs were introduced. Public debt exploded. The central bank experimented with policies the modern world had never seen before. Quantitative easing, asset purchases, yield curve control. Japan became the testing ground for extreme monetary policy. And still, growth remained weak. That is what made Japan so shocking to economists. Traditional tools were no longer working. The old assumptions had failed. For decades, Japan remained stable but stagnant. It did not collapse dramatically. That is what makes this story so important. Most people imagine economic failure as chaos, bank runs, mass panic, sudden destruction. But history often looks different. Sometimes failure is quiet, slow, almost invisible. Life continues. Cities remain functional. Stores stay open. People adapt. And yet, underneath that surface normality, an economy slowly loses its vitality. That was Japan, a country too stable to collapse, but too trapped to thrive. And perhaps the most disturbing lesson is this: it can happen anywhere. Because Japan's problem was not culture, it was not geography, it was not bad luck, it was economic psychology, too much debt, too much confidence, delayed restructuring, fear of short-term pain, and the belief that systems can heal themselves if given enough time. History rarely rewards that belief. The longer structural problems are postponed, the harder they become to solve. And modern economies are not immune. Around the world today, many systems carry the same vulnerabilities: cheap debt, artificially supported asset prices, over-reliance on central bank intervention, and institutions afraid to allow necessary correction. These conditions can feel stable for years, until suddenly they do not. That is why Japan matters. Its story is not just history, it is a warning. It shows what happens when bubbles are allowed to define reality, when correction is feared more than stagnation, and when governments choose delay over repair. Japan was supposed to dominate the future. Instead, it became one of history's clearest examples of how powerful economies quietly trap themselves. And the most dangerous part of all is this: when it begins, almost nobody notices, because decline rarely feels like collapse. At first, it just feels normal. If this changed how you think about economic power, subscribe, because history always leaves warnings for those willing to see them.